Travel is more than just ticking off countries. It's about the people, the culture, the food, the moments. I'm Pippa Hudson, and on Wonder the World, I invite you to join me every week as we explore destinations both near and far, with the help of fellow adventurers who share their unique travel stories. Listen to my podcast wherever you get them.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by ABSA Corporate and Investment Banking. ABSA is a proud lead sponsor of B20 South Africa 2025. Good evening, welcome to the program. I'm Stephen Grootes. I have to tell you, I don't know whether to laugh or cry at that story in the EWN Bulletin. The city of Joburg and their draft budget goes through consultation and everything, saying they would increase the prepaid tariff, the network fee, if you buy your electricity prepaid from 200 Rand to 70 Rand. That's a significant increase, makes a big difference at a time electricity prices are going up anyway, and then says it was a typo. Frankly, I don't know how to be polite here. I don't know if I believe them. I wonder if they took one look at all of the response and thought, actually, I want nothing to do with that. Let's dial it back. I mean, and doesn't that, just the fact that I say that, I'm not sure if I believe you, and I say it so publicly, doesn't that say so much about our politics at the moment? Particularly, I'm afraid to say, in the city of Joburg, if you look at all of the promises and what's actually happening, the lived experience of people who are living in the city. I was fascinated today by a comment by Larry Fink. He is the CEO at BlackRock. He's been there a very long time. He's created really the world's biggest asset manager, the world's biggest privately owned asset manager, perhaps I should say. And he was saying that there are tens of trillions of dollars and euros sitting in cash because of the uncertainty created by Trump's tariffs. So we had the pause yesterday involving the tariffs between China and the US, but the fact is nobody knows what is going to happen. By his reckoning, he said 12 trillion euros in Europe and $11 trillion in the US, just sitting there in cash, not being allocated anyway, not being used to grow an economy, not being used as investment, not actually doing anything, just sitting there in cash, earning, an interest rate, and that's it. And that's because no one knows what to do with it. You may remember we spoke to Donald Mackay yesterday, and he said that the disruption, the uncertainty when it comes to trade is the worst possible thing. I think Larry Fink's put that into numbers for us today. He was speaking, by the way, as sort of part of that Trump trip to the Middle East. He's in Saudi Arabia. But it just tells you the sheer impact that we're seeing on the global economy. We are going to be talking about tipping in about half an hour from now. I would like to think that you are a tipper, or from time to time you receive a tip. I personally, and I've told you this before, get frustrated when you go to particularly a petrol station where someone does give you a service, fill up your petrol, check your tires, things that are really important, and you can't actually tip them using your card in the main transaction. You have to go and find cash. I mean, do you still carry cash around? Do you carry cash in the right notes? Do you have enough? Do you deliberately try and do it? And then are you going to go and draw it and you're in a rush and all the rest? But we'll talk about that. The ease of the transaction surely is a big part of it. But also the culture of tipping does seem to be changing for the good. It does seem that more and more people understand how important a tip is and how big a proportion of someone's income it is. And I think that's just generally, and we don't, and particularly in current context, we don't necessarily give ourselves enough credit here. I would suggest over the last 30 years, we've learnt more about each other and each other's lives than anyone could almost have imagined. Not enough, of course, lots more to be done, but certainly one would like to think perhaps a deeper understanding. Good to hear from you this evening on 011 883 0702 021 446 0567 and voice notes on 072 702 1702.
702. Stephen is on The Money Show.
6 to 8 p.m.
Well, numbers from Statistics SA today confirming that the number of people without jobs, so the number of people who are unemployed, went up by 237,000 in the first quarter of the year. So from the last quarter last year to the first quarter this year, the number of unemployed, and we can argue about this in their various definitions, but in my head I usually carry the figure of around 12 million. Plus minus probably going up past 12 million. And it seems to me that the coalition, which is currently governing the country and national government, have said, and I remember the president very clearly saying, creating jobs was their most important thing. Well, there's clear evidence they're not doing that. They seems to be making no progress. Nothing seems to be moving. Now, don't get me wrong. I don't see any other political entity on the horizon that might change it. What I'm trying to get to, though, is that we see insiders playing with policy here, a transformation fund there, we'll do this, we will do that. Nothing changes for the outsiders, and at the most, perhaps all they receive is the promise of a job opportunity, which may or may not come to fruition, and a social grant. And we should never forget how important social grants are. The point is that nothing seems to be changing. It just seems to be, well, getting worse. I don't know what will change it. At some point, nothing lasts forever, even though it may feel that it does. But at some point, this is all going to snap. I mean, the prediction has been made so many times before. It's going to explode. We do not appear to be doing anything to diffuse our biggest long-term crisis.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, confirmation this morning, the coal mining group Exxaro now spending around 11.7 billion rand acquiring control of one of the biggest manganese mines in the world. It's in South Africa. Exxaro is buying the manganese portfolios from Safika Resources and OM Holdings. It's part of a bigger plan by Exxaro to move away from their concentration on coal. It's part of a long-running plan, I should say. Manganese is seen as a metal that will be used in the energy transition. Mos Ngwasheng is the CEO at Safika Holdings, a big part of this deal. Mos, good evening. You did control these assets. We can see manganese is going to be important in the energy transition. Why did you agree to the deal?
Good evening, Stephen, and good evening to our listeners. We've been invested in this business for the last 23 years. As my chairman and my partner, Sakim Kozoma, said this morning in one of the interviews, this is a business we started from a piece of paper, which was a license given to us by the Department of Mineral Resources Energy. And we've had long-standing partners with us, and we felt that at this point in time is the right moment to realize value for our shareholders, and most importantly, to make sure that when we realize value, the assets remain in good hands, and demonstrate to us what and be able to take these resources and develop them further for the benefit of South Africa and the shareholders.
Did you have many offers over that 20-plus year period, or was this the first substantive offer to come along?
Oh, Stephen, your line is a bit bad.
All right, Mos, I'm going to ask you just to move around a little bit if we can to strengthen the line. The question I put to you, you told us that you've had the asset for over 20 years. Did you receive many offers during that period, or was this the first proper offer you've had?
We've been looking at how to realize value and extract value on this asset for a while. We've had a couple of things that have happened. We even looked at listing it initially. And because it's a single commodity and a single mine asset at the time, there was not good appetite from the financial institutions and the investors. And then we had approaches, and we looked at those approaches. And at that point in time, we didn't feel that the price that they were giving us and the synergies that we could see were sufficient enough to convince us to actually exit the asset. And then, as time goes on, about 18 months ago, we got other approaches, and we ran a process where we had a couple of people who expressed their interest, and at the end of the day of that process, we end up with choosing Exxaro as the preferred bidder, and we've been negotiating with them for a while until this day.
The fact Exxaro, South African, has a long history here, lots of expertise in managing our mining environment. How important was that for all of you in this?
It was very important. Stephen, one of the key considerations that we had to make is to make sure that we enter into a relationship with a partner who's got a long, deep knowledge of the mining assets and mining industry in South Africa, particularly as bulk commodities. And Exxaro has demonstrated that. And the origin of Exxaro as SCs were, and the origin of Safika as well as empowerment parties, we just felt that, it's the right time to do a big champion deal that will really go ahead and continue to develop the South African mining sector as Exxaro intends to continue.
It's an interesting asset, manganese. I mean, how important do you think manganese is going to be in the future? And in some ways, obviously it has certain uses now. It's quite hard to predict what it's going to be. Mos, I hope you're still with us. Mos, are you still there? Right, I'm just going to take that off the line for just a moment, and we'll try and continue that conversation with Moss Ingwashing. I do want to find out what he's going to do with the money now that, that this deal is, in fact, going through. You're at The Money Show. It's 17 minutes now after 6 o'clock.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, a statement this morning from the British and Irish power company, or the power group, I should say, Greencoat Renewables PLC. They're now applying for a secondary listing on the alternative exchange of the JSE. The company produces electricity from renewable sources, sells it to national grids and corporations, primarily in Europe. Paul O'Donnell on the line to us now from Ireland is the co-portfolio manager at Greencoat Capital. Paul, good evening to you. I really do appreciate the time. You already have listings in London and Dublin. Why are you looking for another listing here in Joburg?
Good evening, and thanks very much for having me on the call. Look, we're delighted to have announced that we plan to list in Joburg this morning. It's a market that we've been tracking very closely for a long period of time. And we can see there's a big depth of capital available in South Africa that's interested in having exposure, I guess, one, to the European energy transition story, and two, that plays on the key business model that we have around delivering stable dividends to investors and having locked in inflation-protected revenues in our underlying assets, which provide secure long-term cash flows for our investors. So we think that resonates well. We've spent a lot of time in South Africa. We've met with a lot of local institutions, a lot of local wealth managers, and we feel that there's an opportunity to bring the story to South Africa and provide something I think that is pretty differentiated on the local stock market.
I mean, I'm sure you know how hot a story electricity is in South Africa. I know it is across Europe and in the UK and Ireland as well, but it's something we've been talking about all the time. Could this be a step to expanding your operations here as well, your active operations in South Africa?
Look, we follow very closely what's happening on the ground in South Africa. We understand it's a challenging market at the moment, from a power market perspective. And look, we think our listing, will help to bring further expertise to the market. What we do and what our underlying investments are ultimately, wind parks, solar parks, battery storage, all of which are invested across pan-European countries and that are underpinned by good long-term inflation-protected revenue contracts. What that has allowed us to do is to bring in external private capital and allow global investors to have exposure to that opportunity. And we think, that should resonate well in South Africa. It should also help to provide a business model understanding about how to mobilise the private capital that is needed to finance energy transition and to finance both the grids and the renewable energy assets that are now going to need to be invested both in Ireland and in other markets as well.
This transition to renewable energy requires a huge amount of capital, a lot of money. We've seen, obviously, that because of the identity of the person in the White House, they don't seem to be as keen on this transition as other people. And yet the economic case for renewables obviously hasn't changed. It's incredibly strong. Is the capital still as keen to get involved in this process, in the energy transition, as it was, say, 3 years ago?
That's a really good question. A lot's changed in the last 3 years. We've seen big changes in interest rates. We've seen the impact of inflation. And also we've seen, in the energy transition sector, probably, some of the hype, coming out of the sector as some of the oil and gas companies have exited and, some of the capital that was more short-term in nature also started to exit. So, a lot has changed in terms of macro factors over the last couple of years. But what we have seen, I think, and I'm sure the same opportunity is there in South Africa as well, is that the demand growth for electricity is not stopping. I mean, you can see that today in terms of base demand for electricity, be that from growth in electrification of transportation, electrification of heating, as well as decarbonising the power grid. And then in addition to that, what we've seen in the last 12 to 18 months is the emergence of AI and data centres as a huge new power source. And that's putting a lot of pressure on the electricity sector. And what it really means is that the level of investment that's needed is increasing, not slowing down. in terms of, what does that mean for investors? It means investors need to be paid the right returns to invest, and returns have actually gone up over the last number of years. So as interest rates have increased, and as I guess, we've seen less capital in the energy transition space, the returns that investors can make have actually increased. And so we think it's a pretty attractive entry point actually right now for investors to get this exposure to a very, very interesting sector.
And I mean, the joy of it, of course, is the sort of long-term nature of it. How quickly are you planning to grow over the next few years? I mean, you'll obviously have some expansion plans, which is why you need the money, which is why you want the alternate listing.
Yeah, thank you very much. Yeah, look, we're a relatively young company. We listed in Dublin in 2017, so we're coming up to our 8th anniversary this year. The business has grown from about 250 billion euros in assets to over 2.5 billion in assets in the last 8 years. So we've already grown to become quite a large business and one of the leading renewable infrastructure companies in Europe. However, as you know well, infrastructure is a very capital-intensive business, and we see huge opportunities for further investment. We expect to be able to deliver on that growth opportunity in Europe over the next 5 to 10 years. And the opportunity for growth, allows us to deliver similar type of scaling from what we've done in terms of 5 to 10 times growth in the last 7 years alone.
Paul O'Donnell, thanks very much indeed. Really appreciate the time. Co-portfolio manager at Greencoat Capital on the line from Ireland, where I believe they are not in stage 2 load shedding.
The Money Show.
The markets.
Marco Eustathio is the lead specialist, investment and trading sales at Absa CIB. Marco, good evening. Good to see you again in our studio. The Exxaro acquisition moving into manganese. We had, I suppose, not as long an interview as we would have liked with Safika Holdings and Mossen Guasheng a moment ago, but just evidence of what Exxaro is trying to do.
Hi, Stephen. Absolutely right. I mean, they have given the market plenty of warning about wanting to go into future-facing metals. I think this ticks that box quite well. They get immediate exposure to pretty high-quality manganese. I would say there's a little bit of skepticism in the market around this transaction, and for a couple of reasons. Firstly, it looks like they're paying about a 70% premium to similar assets that are out there. Granted, this is a much larger asset than they'd otherwise get. But also, I think some portfolio managers questioning the exposure to steel production, because that is what manganese is primarily used for at the moment. As you said, it could be used for other things in the future, but this is a big price tag to be paying for something that increases your exposure to steel. We're talking 20 to 30% of their market cap in this deal. So a fair amount of skepticism, but at least they're doing what they said they would do.
It explains why their shares were sort of very slightly down on the day. And then also, if you consider all of the noise around ArcelorMittal and steel, I mean, I suppose correct to ask some questions. It still seemed to me, just looking at the markets, the JSE, and perhaps to an extent what's happening in the US tonight, that really everybody is still a little focused on the US, China and Trump.
Absolutely right, Stephen. I mean, we've seen this tariff unwind trade continue today. Some of the movers on the exchange today, South 32 up a whopping 7%, Anglo-American, Glencore up 2.5% and 4.3%, Richemont still outperforming. All of these stocks pretty heavily exposed to China and the Chinese economy. So you can see the relief rally around this 90-day pause on tariffs definitely coming into effect. I do highlight it's only 90 days, so I think there's lots of fun and games to come.
I mean, Larry Fink's comment today that there are literally dozens of trillions, scores of trillions of dollars and euros not being invested. I mean, I presume I wouldn't disagree with them. I don't know if you would. But I mean, that must be the case. There's just so much money lying around, not doing anything productive.
Absolutely, Stephen. Lots of fear out there. I think people go and hide in safe havens. Particularly we've seen in the past gold, dollars, as we saw yesterday. Some of that unwound a little bit with the tariffs potentially unwinding, but I think it remains a key concern for investors. We don't have any certainty on what's going to happen with these tariffs, and until we do, I think that a lot of capital is going to sit on the sidelines.
South 32, strong day yesterday. They had the announcement that Matthew Daly is going to become their CEO. He's coming from Anglo-American. And then another strong day today. How much of that is about just the sort of resurgence in some mining shares because of the tariff issue, and how much of it is about their own news?
I think a bit of both, Stephen. I mean, if you look at it, Firstly, you've solved a key succession issue that South 32 might have had, bringing in quite a strong candidate from Anglo American, where he was technical and operations director, previously operating Glencore Copper. So, really safe pair of hands to come in and run that business. But what I would say is, when the tariff news was announced yesterday, probably most of the Australian markets were closed. So we saw a bit of catch up in the Australian share price of South 32, and we followed that. The price does tend to be made in that market. But definitely underlying share price, but also just a really nice succession plan coming into fruition.
And then MTN, they seem to finally be catching up to Vodacom after a little while.
Absolutely. We've seen over the last couple of days about a 3% catch up. I would say this is twofold. One, just the move again into slightly more cyclical stocks, which MTN ticks the box for. Vodacom very defensive with a high dividend yield. But also, I think MTN's Q1 numbers were quite encouraging for the market. We saw, really good cash going back to the center from a lot of the markets. Some positive comments around what's happening in Nigeria, particularly around the increase in pricing, not seeing negative elasticity effects, which I think the market was expecting. So that was quite a nice bit of good news.
Thanks very much indeed. Marco Eustathio is the lead specialist, investment and trading sales at ABSA CIB. A lot more to come, of course, and just keeping an eye on what's happening on US markets. We'll talk more about our unemployment stats in a few moments. Also, don't forget that conversation around tipping. How much do you tip and why? 011 883 0702 021 446 0567.
The Money Show
with Stephen Grootes.
19 minutes to 7 the time. Well, you probably know about me that I quite like a good political move, a strategic move. Doesn't matter who makes it or what their aim was, but just the idea of making a clever sort of step in politics. And I thought President Cyril Ramaphosa probably did that today. He arrived basically unannounced at the big agricultural show at Nampo, underway in Bothaville in the Free State. It is the biggest agricultural show in the Southern Hemisphere, often famous because you see so many farmers with so many planes, usually very small planes. But certainly it is interesting to see the president arrive there. And according to his people, his farm manager actually asked if he could go as a farmer rather than through the presidency. Lots of very clever moves here. And he was asked, of course, as you can imagine, I think by News 24, he was asked about the, in inverted commas, refugees, the 49 people selected by the Trump administration to go to the United States who landed there yesterday. And he suggested that people who run away from our problems are cowardly. And I was very intrigued by that statement and the entire move. I made the point yesterday that next week, President Cyril Ramaphosa is likely to find himself in that chair once briefly occupied by the Ukrainian President Volodymyr Zelensky, in front of Trump himself, the President of the US, in front of a White House press pack that tends to support Trump and ask quite difficult questions of the other heads of state or political leaders who happen to be sitting in that chair. And I just wondered if maybe the person to watch in sort of geopolitics over the next few days might, despite everything that's happening elsewhere, be President Ramaphosa. It will be a very, very big opportunity for him next week, if that meeting happens, for him to say something and to be seen to be doing something. And he is also in a position of legitimacy to do it. We also don't depend on the United States as much as Canada or Ukraine. Strange as that may sound, he might actually be in a stronger position than Zelensky or the Canadian Prime Minister Mark Carney. I would watch Ramaphosa and his signals around Trump very closely over the next few days.
The Money Show
with Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
Well, confirmation from the quarterly labour force survey today that in the first quarter of this year, the number of people who were employed, had jobs, dropped by over 291,000 people, and the number of unemployed people was up by 237,000. Sharmi Surianarain is the Chief Impact Officer at the Harambee Youth Employment Service. They've been working for many years to get young people into jobs. Sharmi, good evening. I do appreciate the time. There is often a seasonal aspect to employment numbers, and you particularly need to be careful about jobs created over the holiday period, which of course the fourth quarter was last year as compared to the first quarter this year. But I was still quite surprised at this number. It does seem to be a big drop in the number of people who are working.
You're absolutely right, Stephen. Firstly, good evening and thank you. The numbers are bleak, and unfortunately, it's true that young people continue to be left out of the economy, and this is true of the good times, and is true when the GDP growth is low, like we have had this past year, and probably going to be forecasted downwards. So Harambee looks at young people in particular, but it is pretty unfortunate that the overall unemployment has shifted upwards as well, which for me is a cycle both of the kinds of sectors and the uncertainty that we're experiencing in the economy. But from Harambee's perspective, young people continue to be particularly left out of the economy, and that's something we really need to watch out for.
We've been told for so long that certain things will change. There'll be different political parties in government. Well, sort of tick. Load shedding will end. I mean, earlier today I could have said tick, but let's give it a half a tick. That there will be all sorts of other things happening. And yet none of the really important structural stuff, and it is important, it's not having any impact on the number of young people getting jobs now.
You're right, and it is disturbing. It's something which keeps us up at night. Look, some of this takes time, and unfortunately we are paying the price for decades of exclusion and jobless growth and a decline of manufacturing, and a whole host of sectors that South Africa did have a competitive advantage in. And this is despite the many scaling successful organizations like our own, which have enabled young people to get work. We have stemmed the tide of the crisis, but we haven't reversed the tide. And there's many reasons, and this is unfortunately not just true of South Africa, this is true of the world, that young people are being left out of the economy. But we do see, for example, that when there is work, like these past few weeks, Harambee has received 16 million applications for 200,000 slots in 22,000 schools for teaching assistants, for example, across the country. We do see that there's evidence that young people want to work when there's work. So for us, it's these bright spots that we need to focus on, that young people are ready and willing, and other bright spots like, for example, sectors that have bucked the trend, that are growing counter-cyclically, like global business services and tourism, and can employ youth. This is where we need to amplify, invest, and coordinate. And for us, there's no silver bullets. We actually need all solutions on the table.
I mean, tourism is in a way the one because the people come here. You don't need to own manufacturing services. It's relatively easy. I've never worked in the industry, but I'm told it's relatively easy to upskill people to be able to, help people who are coming here as tourists. That's always been the one to focus on, along with agriculture. And of course, the global climate does make it suddenly quite difficult.
Absolutely. I mean, we're standing now in post-tariff land. Hopefully things will adjust back upwards. But we have to be prepared for a few shocks to both our growth forecasts. But we've seen a disturbing trend in South Africa that despite GDP growth, young people are still being left out. So we know that growth alone won't fix the economy, particularly for youth. So we need targeted interventions to include young people, which means employers need to invest in youth. They need to drop unnecessary barriers, create conducive workplace environments for both jobs of today and for tomorrow. And we need government to create enabling environments to actually stimulate innovation and growth. And social enterprises like ourselves, like YES, and a whole host of others to actually work across the table for coordinated solutions, because the Arab Spring is going to be nothing, unfortunately, if our unemployment numbers continue to grow. Yeah, I was making the same point earlier, and it's been made so many times, and I fear will be made again. We understand, and I think we've known for a long time, that part of the problem is our education sector. There are some signs of improvement in our schools, thank goodness. But we've known for a long time that the skills that we are producing, the skills that people come out of school with, doesn't necessarily get them into a job. And yet it also seems to be true now that the number of people who are graduating from tertiary education, so university graduates, are not finding jobs. So it can no longer be just a skills problem. There is something else going on. Right. Well, I think that's our young people stepping into a world that's unfortunately in crisis. We have an education system that's failed them. We've got very few jobs being grown in the economy, and that's getting worse due to global factors as well as technological disruption. And so we're really putting all of the pressure on the young people rather than fixing the system. So we need a composite of solutions. We need, firstly, the education system is a long lever. It needs to be shifted. But we need short, sharp, ready, demand-led skilling that gets young people ready for the work of today rather than long lever programs that are expensive and don't actually get young people into work. But importantly, we need to unlock jobs of tomorrow, like GBS and tourism, in partnership with the private sector. We need the informal economy. We can't have young people doing nothing. We rather would like for them to be earning something and scaffold them so they're not just earning true level. And we need public employment to work, to be transparent, to be efficient, and to pathway young people as a stepping stone into many other opportunities. So we need all of these solutions across the table, and unfortunately no single silver bullet exists.
Yeah, I mean, I just don't see, unfortunately, and I sort of bang my head on the table, but I worry that if I'm despairing, and I have a job, people who don't have a job must be in utter hopelessness, and there's nothing really that's being put on the table for them.
Look, I think it's one thing, Stephen, you might, see as a source of hope for us is we actually surround ourselves at Harambee with young people. If you come visit us in our offices in Braamfontein, we have roughly 150 young people working the phones, formerly unemployed youth themselves, supporting other unemployed youth to not give up hope. This is something that's a single source of, I think, encouragement because young people have potential, they have creativity, and they know the solutions. They have agency to make very little out of, or a lot out of very little. So in the absence of all of these, the jobless growth and the bleak numbers, I think we need to trust in the agency and potential of young people, really invest in young people. We have a saying at Harambee, don't make a bet on youth, invest in youth and create the opportunities. So, and I mean, I often say that pessimism is a privilege. Young people are optimistic and full of hope. It's up to us to break the barriers, to create the opportunities, and really take a chance and ensure that they are included in the labour market.
Sharmi, really appreciate the thoughts. Thank you. Sharmi Surianarain is the Chief Impact Officer for the Harambee Youth Employment Service.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, a suggestion on LinkedIn this morning from the CEO at Tipped that new research is showing the average tip for petrol attendants or car guards is now around 30 Rand. Now, when you consider that there's a big transition away from cash, that probably makes it harder to tip. This is a very interesting number. Kimberlyn Temple is the CEO at Tipped on the line now. Kimberlyn, good evening. Tipping is one of those things that I hope most people do. Many people receive. We don't really talk about it much. What kind of information is available about how much money people are receiving as tips?
Hi, Stephen. Thank you so much for having me on your show again. It's wonderful to be here. So absolutely. I mean, it's a surprising stat that's come forward for us to see, the average tip that's coming through and through our platform is now 30 Rand a tip. And this is for fuel attendants and for car guards in general. Seeing this is there's a psychological shift in, as opposed to handing over money, right, to give a tip, digging for a 5 Rand, a 10 Rand, whatever you may have available and on hand, to now tip digitally and through a mechanism as which we've enabled. We're seeing the shift, and that's where we're seeing the increase, which has been a beautiful thing to see.
How difficult is it to make all of these transactions work? Because you're looking at a relatively high number of quite small transactions of very variable amounts.
Absolutely. As I say, on average, what we're seeing, the average tip that's coming through is 30 Rand per tip. We're seeing, depending on the industry that we're dealing with and that we are sort of researching and reporting on, we can see an average with fuel attendants, for example, 12 to 20 tips a day that are currently coming through.
So if they're getting 12 to 20 tips a day and that's 30 Rand, it's a really significant a part of their income. Do we know how big a proportion that is of their total wages? I mean, for some, 2 or 3 big tips a day will make a huge difference to them and their families, considering how much they're earning formally.
Absolutely. And that's, I think, why I'm so passionate about tips is because of that. When we first ran our initial pilot, we managed to increase revenue, and we've seen this as almost like a common trend that we've worked with and we've seen throughout our different pilots and proof of concepts that we've done across different various industries and service sectors. But we've seen that we've managed to increase revenue by almost 40%. And I'm talking about the car guard in that instance. I was recently talking to one of the fuel attendants that we've signed up. He was saying to me that he's got over 4,000 Rands worth of tips in his tipped wallet. Which is just, it's beautiful, to me that's incredible, and they can almost supplement or add or contribute to almost 50% of their earnings, which is fantastic.
I'm always interested in how management of anything, I mean a restaurant, a petrol station manages tips. I know some It's very easy. You just, if you go to a petrol station, you buy the petrol. As you pay for it, you can add a tip. And I've always asked the petrol attendants, do you get it all? They say they do. And off you go. Some petrol stations don't do that. And if you consider the amount of money moving through a petrol station, I mean, some places they're very, very busy. There's a large amount of money moving through there. And these petrol attendants are not getting anything. I've never really understood why some petrol stations do it and some don't.
Absolutely. And what we're seeing, especially in the industry that we're in, many petrol stations are actually, they're not allowing the fuel bill and the tip to be included in the point of sale device or as one transaction. So they have stopped this. We've seen this in restaurants. We're seeing this more and more as a trend at the moment. And basically it's because it's an administrative and financial nightmare to deal with that, to delegate out fairly and equally, and to the right recipient too. This is where TIPT is coming in. You know, not only are we uplifting and empowering individuals by giving them the mechanisms that we have through the digital wallet, but on top of that, we're actually revolutionizing tipping cultures and tipping processes. And within that, this is what we're seeing and how we're seeing these benefits. Is we are seeing that the tips are obviously they received by the individual themselves, by the tippee, and they received instantly. This has provided us obviously with the tracking and the insights that we have in order to report back on seeing the frequency and value of tips. But again, this is taking a level of management out of the equation, and this is where we're revolutionizing things at the moment.
I presume there's a big impact in terms of the ease of the transaction. If it is easier to pay a tip, people are just much more likely to pay a tip. If it's harder, you're just a lot less likely.
Absolutely. I mean, the thinking behind it when I first started TIPT is as long as it would take in length of time for me to find a 5 Rand or a 10 Rand note, whatever the case may be that digging in my handbag or searching through my purse or car, whatever that case may be. But however that length of time, however that long that takes, it should take the same length of time, if not quicker, to send a digital tip across. And that is our aim. You know, it should happen within a couple of seconds. And again, the easier it is to use, the more options we have available, the better the chances are of that recipient actually receiving the tip that they deserve.
There are lots of people, they're happiness economists, which sounds like a contradiction in terms, but people who try and measure happiness. I've often wondered if at certain times of the year people are more generous with their tipping. I mean, over the Christmas period, maybe not on New Year's morning, but maybe on New Year's evening, you'll find that people are actually a lot more generous. I mean, there'll be a lot of data to look at.
Absolutely, and it's been fascinating data that we've received out of this. So obviously over the December period, the tips are a lot higher. We saw an enormous drop over the January-February period, and then again picking up March to April, the Easter weekend. Again, it's a time for giving and Thanksgiving in a lot of ways. And so we do see these spikes within it and these trends. But again, super interesting because as opposed to cash being received in tips, we are now getting live, real data. And that is across various different service sectors, various different LSM levels, industries, as I say. So for us, it's fascinating to watch these trends, these spikes and drops as well.
Kimberlyn Temple, thanks very much indeed. CEO at TIPT. I wasn't aware of how complicated it was for petrol station managers to sort of work out who the money should go to. And that does make me think a little bit. I don't have a huge amount of sympathy for petrol station managers, but maybe I have a little bit. But there is something going on in the tipping industry that is really worth just looking at and something worth considering when you sort of pull up, or maybe you're someone who receives tips. It would be good to hear from you one way or another. 011 883 0702 and 021 446 0567. Lots to come in the next little while. You're with The Money Show at 7 o'clock.
And now, The Money Show
with Stephen Grootes on 702.
Let's walk the talk.
The Money Show with Stephen Grootes is brought to you by Absa Corporate and Investment Banking. Absa is a proud lead sponsor of B20 South Africa 2025. Good to have you along this morning, this evening. Intriguing to hear conversations around tipping. Lots of people with strong views, of course, on how much you should give. And a tip used to be for sort of good service. I think it's become something else now. And I think maybe very importantly too. We'll talk about shipping in the Suez Canal in a few moments. Something, we've been speaking about the politics of trade, but the business of trade that's been so severely disrupted. And then Warren Ingram this evening talking about keeping money simple. It's not necessarily that easy to do, but Warren Ingram, of course, with personal finance. Lots to say, and good to hear from you on 011 883 0702 and 021 446 0567.
702. Stephen is on The Money Show.
6 to 8 p.m.
Voice notes on tipping coming through to The Money Show tonight.
Hi, Stephen. I do not think the average cargo tip is 30 Rand. That's certainly not true. I work in the restaurant industry. I can tell you that, ironically enough, on Mother's Day, the tips are about 4 or 5% because these are the people that come out once a year and they don't understand sort of that 10% is an expected amount. So I worked all day Mother's Day, and I can tell you across the board that the tips were, 4 or 5%, $20 on 1,000 Rand, stuff like that. And getting to 10% in South Africa in the restaurant industry is a massive achievement. I can tell you from a waiter's perspective that if you do get to 10% at the end of your shift, then you've done really, really well. So I don't see how a car guard's getting 30 Rand average.
Sure, that's interesting. 20 Rand tip on 1,000 Rand bill. Ay, I would be ashamed. I mean, I understand it's tough, but still, that's very, very low. I mean, do you budget tipping? So, Vian, I'm sorry to hear that story. Do you budget for a tip when you go out? It's sort of part of, how it's all going to work. Be very interested to hear from you tonight on The Money Show.
The Money Show on 702.
Monday to Friday, 6 to 8 p.m.
Well, the actual business of trade, the moving of goods around the world, had a very difficult time. We've been talking about the politics of China, the US, and the US President Donald Trump, but now the business of it has been hugely disrupted. And the area around the Suez Canal, particularly because of attacks by Houthi groups in Yemen, they've used rockets and boats to attack ships in that area. The US has attacked them, dropped bombs on the ground, on the groups doing this. There was over the weekend a sort of truce that seems to have emerged. Kind of hard to know what's really going on sometimes. It's a very complex area. There are many different actors with lots of different agendas, sometimes contradictory agendas as well. Timothy Walker is a senior maritime researcher, joins us now. Timothy, good evening. Thanks for your time on The Money Show. A lot of moving parts around the number of ships moving through this area, through the Suez Canal. Is this still a very high-risk zone for shipping?
Good evening, Stephen, and good evening to everyone listening. It is quite a high-risk area. The risk has gone down quite significantly over the last few months. There hasn't been a successful Houthi attack of a ship for several months. So there's an increasing interest from shipping companies, people who are buying and trading the goods, to see the costs associated with taking a ship through the Red Sea and through Suez go down. Particularly the Egyptians, they are quite keen to see more ships return. And if the security costs remain relatively high, they're looking at other incentives like reducing costs of transiting the Suez as one way of maybe offsetting those security considerations.
I mean, I suppose one of the issues is we don't know if this truce between the US and the Houthis will hold, and certainly the timing during Trump's trip to the Middle East may indicate this is only temporary.
Absolutely. The deficit of trust and the confusing messages which are always being signaled around intentions of the Houthi or Ansar Allah, as well as the United States nowadays, which is always quite mind-boggling to say sometimes when it comes to maritime security in particular. The levels of concern, like I say, are quite high amongst shipping companies who have devoted a lot of their resources and energy to exploring how to move goods around the world which don't go through this area. So they've laid a lot of time and investment in, for instance, coming around the Cape of Good Hope in South Africa, but also other areas too. So there's a lot riding on it. There's a lot of stakeholders. And interestingly, I think the move, in particular from Egypt recently, about potentially reducing temporarily the cost of ships going through the Suez Canal could introduce a few more stakeholders into the mix. I think the Egyptians have been in a situation where they've been very struggling with the lack of ships coming through and the lack of, I think, maritime security, which they themselves are able to produce in that area, because the Houthi have been very adept at linking their campaign against shipping at sea to the situation in Gaza, and to be seen as anti-Palestine for any Arab country would be a tremendous risk for their stability.
I mean, I was intrigued that so Suez Canal is offering a 15% discount, but really on very large container ships. So they're targeting a very specific kind of ship, the ship that costs a company the most if something happens to it.
Absolutely, yeah. The war risk premiums, the insurance rates which ships have to pay if they're going to be obviously reimbursed if something goes wrong, tend to be calculated on the value of the vessel and the cargo. So those big container vessels, everyone remembers the Ever Given, which got stuck a few years ago. Those kind of containers often carry very high value goods. So the insurance rate that the company will pay, or the shipping company will pay, will be based on that calculation. So to get that down is what a lot of people want. But the cost is still seen as the offset of this 15%, even temporarily. I don't think it's going to be too attractive to a lot of companies to actually reroute their ships through the Suez, because I think the risk still of the Houthi leveraging more ships in the area, more targets, more economic possibilities like they've leveraged over the last almost 2 years would be very tempting, and that could also be another problem with any kind of ceasefire.
This all comes against the backdrop of the US and China, and the trade war must be hugely disruptive. And I presume, I'm sort of going to ask you because you know more, but I presume there were huge orders to get as many ships on the sea to the US before any tariffs could come into effect, to get the goods, to land them at Los Angeles before any tariffs could come into effect. Then when the tariffs are in effect, everybody sort of slows down. So now you've got spare capacity. Now no one knows what to do.
Yes, when Trump won the election last year, there was predictions of a huge surge in shipping to get goods to the United States, or United States people to import before any kind of tariffs, because this is exactly obviously what he was saying on the campaign trail. But the implementation of this tariff program has been absolutely sort of mind-boggling for too many people to really comprehend. So they're trying to control what is in their control. And things like shipping windows, the window of trade, for instance, the amount of time it will take to cross a particular area, the amount you'll pay, the destinations, those things which can be controlled, they're looking to exert control, which is very, for instance, Egypt. One of the only things they can have any real autonomy over is what they can charge for Suez. Companies like Maersk, for instance, aren't looking at that with any kind of real interest, because the security guarantees from the United States, on top of the tariffs they're having to pay as well, or might not be having to pay, those kind of calculations, they don't need that added stress. So if they've got a relatively good, secure route around the Cape for the high-value goods, they'll continue to do that. So Egypt is playing a bit of a gamble here with the reduction of the rates as well. It's not a huge amount, and it's for a temporary, because it's not supposed to be a permanent measure. But nevertheless, we're not sure how much it's actually going to attract the shipping back in the long term. I think there's a lot more guarantees, particularly on the security side, which have to be in place before that happens.
I presume if we have obviously the shipping trade, the industry moves in fits and starts, but just this level of disruption for this period, call it from, say, the beginning of, say, March 2020, but then the disruption we're seeing now, all of that must be hurting long-term investment. I mean, people might have, on a graph 10 years ago, thought, well, this is where we'll be as the shipping industry by 2035. They don't think that now.
Well, the shipping industry has actually profited quite a bit from insecurity and longer voyages, because they can charge more for the goods which are coming, sometimes obviously with the interlinked global economy and supply chains from all over the world. So a lot of money that, for instance, shipping companies gained as a result of COVID, because it was very difficult to sail and you could charge higher prices. A lot of that has been invested in extra shipping capacity. So they effectively built new ships. Maybe some of them are more suited for future regulations around climate and greenhouse gas emissions from vessels. But there's a great deal of capacity at sea. So there's shipping companies have actually been quite. I wouldn't say they've been benefiting per se, but they've not been harmed as much as others. For instance, countries like Egypt, again, as a prime example, not being able to derive as much revenue from the Suez and complicating a huge economic crisis that they've been only starting to emerge from over the last 2 or 3 years. And this could be the case for other countries, maybe Panama with the Panama Canal in the future, but also countries like South Africa. We do want to see more ships coming round the Cape who might be calling in at Cape Town or Durban to take on fuel, but also because there'll need to be more ships for African countries if we want to grow our economies in the next 5 to 10 years, there will be a need for more shipping. So there's always that risk of, well, if we don't prioritize and get things right now, we're going to be dealing with higher costs in the future, and a situation where decision-making is completely out of our hands, as, for instance, Southern African Community Customs Union, those kind of actors, their say over what shipping companies can set for rates, but also insecurity in other parts of the world over which we don't have much control, like, for instance, Suez, will be a tremendous factor.
Timothy Walker, thank you. Really appreciate the time. A maritime senior researcher.
The Money Show
With Stephen Grootes, live on 92.7 and 106 FM. Streaming on the Prime Media Plus app.
and DSTV channel 856.
RMB Africa Focus is brought to you by RMB, a proud sponsor of the B20 and a leading African corporate and investment bank. Nice to welcome to The Money Show the journalist who covers Africa so well, Crystal Alderson. Crystal, good evening. Welcome to Africa Focus. Let's start by sort of setting the context. We've been talking so much on The Money Show about the relationship between the US and China. We all watched the situation with Russia and Ukraine, which of course the US and Europe are hugely involved in. There are huge global headwinds here.
Good evening, Stephen, and good to be with you. And over the next few weeks, we'll be delving into different issues. But tonight, I want to set the scene because we know that there's global headwinds. We know geopolitics is constantly shifting. We know China and US, but how is that impacting on Africa? So firstly, we're looking at the IMF. They have said in their latest report that the continent there's been some hard-won recovery, especially post-COVID, but of course, recent events and shocks, including additional constraints on external funding, the debt crisis, downturn in global demand, and then, of course, also massive aid cuts and key commodities will impact on our growth rate. So the World Bank estimates that we're going to have about 3.7% growth for this year. The African Development Bank, much more bullish. They're saying 4.3%. And also the fact is, despite all the challenges, Stephen, Africa remains the world's second fastest growing region after Asia, with about 12 of the 20 fastest growing economies projected to be on the continent. So I do think one cannot dispel that despite the challenges and the geopolitical shifts, there is still some opportunity here in Africa.
I mean, that growth, where do we see the growth? And unfortunately, we're not really seeing much of it in southern Africa, but it is also a story of how, and I'm always a bit iffy around this word, how resilient some of our economies are.
Definitely, Stephen. It's not going to come from South Africa and Egypt, which of course are the biggest economies. But I think before I go there, it was interesting seeing yesterday President Cyril Ramaphosa and President Paul Kagame at the Africa CEO Forum in Abidjan. It's the first time that, of course, they sat so close to one another. And actually, they agreed, for instance, around the fact that there's always going to be noise. We need to stop listening to the noise because Africa is an engine of growth. And Kagame was actually quite forthright. He was like, can we just stop listening to what Trump is telling us? Can we actually just focus on building our own resilience? And I thought that was very interesting coming from him. So I think firstly, one looks, for instance, the World Bank's private investment arm. They're planning to significantly increase its equity stakes here in Africa over the next 5 years. And that is the IFC. We're looking at close to, they say, around $14.2 billion in commitments. And that is not to be, that's quite an amount. So we're looking at, they're saying they're going to invest heavily in across Africa, digital infrastructure, agriculture, manufacturing, business development, and clean energy. But as you said, we're not going to see much growth in Southern Africa. We will see it in East Africa. It's absolutely quite incredible to see Kenya 4.8%, Rwanda 7.1%, Uganda 6.1%, West Africa always shining stars. We see Ivory Coast 6%, Ghana, despite its own challenges, 4%, and then Senegal, the absolute rising star, about 8.4%. And in Southern Africa, we do have two shining stars, so to say, Stephen, Tanzania 6%, and then, as I said, Zambia 6.2%.
The World Bank, obviously, their private investment arm, they do seem to be planning to significantly increase investment. What is it that they're looking for? I mean, obviously, digital economies too.
So, Stephen, I think your previous guest that you had spoke about shipping. And if we look at, for instance, firstly, Africa's got about 30 million square kilometers, and it's home to, of course, minerals and natural resources. In fact, we've got about 30% of the globe's critical mineral reserve. So a big issue, roads, ports, infrastructure, and there's massive money in that. In fact, pension funds, and we hear from experts that in Africa alone, there's about $2 to $3 trillion of money available in the different pension funds. And this is where the private sector, banks and governments, of course, are trying to have this public-private partnership to see this unfold. And so the World Bank being really, and the IFC in particular, being bullish and saying, look, we actually want to invest money. And they looking at, as you said, digital infrastructure, agriculture, clean energy, and manufacturing.
And the sort of forecast and investment trends, where's the smart money going in Africa at the moment?
Yeah, so I think if we look at the RMB Outlook report, they're giving us 31 countries and Africa's top 5 investment destinations, still island economies, Mauritius, and then we're looking at Egypt, Morocco, and South Africa, despite that the economic growth in those countries might not be as high as Senegal. But I do think what we see countries like Senegal investing in infrastructure, because politically they had their own challenges, they are now attracting more investment. We see in Kenya, despite its own challenges, they still have a big startup culture, digital innovation, and of course also energy. We're looking in Uganda, agriculture that is also still tops in that country. And I do think I've been watching what's happening in Ethiopia for quite a while, because it is interesting from, where it came in terms of its own challenges politically, but they've been so focused, Stephen, on infrastructure. I mean, I spent a lot of time in Ethiopia over the years, and I can tell you it used to stress me out, Stephen, trying to file a story because the internet would inevitably go down. You would struggle with accommodation. Sometimes the accommodation I ended up, and just the road infrastructure. When I went there recently, I was so shocked at one, fantastic internet, hotels, fantastic, the road infrastructure, they've got their own kind of train system. And it's very interesting how Ethiopia, slow and steady, have focused on their own, firstly restoring some sort of macroeconomic stability, build resilience, and the government, of course, looking at how they can prioritize sorting out their own system in terms of liberalizing, because there's not a lot of private sector per se as compared to the rest of East Africa. And they've been getting new private sector players along. Not everyone is always interested in it, but they've been able to really get support from the massive diaspora, Ethiopian diaspora in Sweden, in the US and elsewhere, to come and invest in the country. And so Ethiopia is always an interesting study for me, because having seen the evolution over the years, you can really see what, when there is absolute focus, when you have a diaspora that wants to see the country really supercharge, and then, of course, international organizations or multilateral institutions willing to invest in that country.
And the G20 and the B20, is that important for our continent?
It is, and we saw our president went to Abidjan exactly to get some support, and we do see, and I think, Stephen, there's so many events. I try to keep track, but there's about 200 G20 events, and I think it's quite massive. So we look at the foreign ministers, we look at the heads of state summit that's going to take place in November, but there's other very key events taking place. I see, we also see the African Union being now a member of it, also playing pivotal. And I think we're not going to see overnight what the G20 has meant, but I do think that the fact that South Africa is chairing this very pivotal moment, and we have a specific B20, of course, which is the business community, and we see their involvement from education to trade, to infrastructure, to technology, because we cannot, I think there's a realization within African governments that they cannot do it alone. They would need the help of the private sector to start unlocking growth. And I think the B20, the G20 allows for that discussion to take place in a very focused manner. And because South Africa is chairing it and there's been different African countries invited, I do think that conversation is moving. And keeping in mind, we've got the Africa Free Trade Agreement in place as well. And I think we're going to see some acceleration of it. Of course, we want to see things happening overnight. We want to report on it, Stephen, but these things are often quite slow. But I do see the unlocking, and having followed what's happening across Africa, things are moving. Definitely the realization around infrastructure, digital, the digital economy, access, for people to access Wi-Fi. I think those are game changers, and things are changing across the continent.
Thanks very much indeed. Crystal Alderson, a journalist covering issues on our continent.
Your African expansion is boarding now with Harambee. From telecommunications and infrastructure to renewable energy and agriculture. Partner with Harambee for first-class business in Africa, where every venture is one of endless possibility. Harambee, a leading African corporate and investment bank. Harambee, a division of First Rand Bank Limited, a registered FSP and credit provider.
The Money Show. Personal Finance with Warren Ingram.
And Warren, of course, is a certified financial planner at Galileo Capital. You've heard so many times, you hear so much about how to invest. There are lots of different concepts. Warren, good evening. Tonight you want to focus on keeping things straight and simple.
I have to, Stephen. It's the only way I can understand it, and I think the business of money, and especially personal finance and investing, is often very scary for a lot of people. And anyone that's gone to a doctor and had them ask you a bunch of questions in a language that sounds very far from English, or a mechanic who tells you about something in your car might have an understanding when you go to a financial person and then they start to spew all this jargon at you. It just seems phenomenally intimidating. And for a lot of people, I think they tend to avoid the conversations around money just because they're afraid that they might look silly, or that they might seem ignorant and might not understand the world of money. And I think it can be a relatively simple thing. It's made complex by my industry, and there's reason for that. These guys all got to get paid somehow, but you can make this simple, and you can manage the world of money fairly effectively by following a few key principles, and don't get intimidated.
I mean, a lot of it is about the words, and I love the fact that you picked up on the language, because so much of it is about the words that are used, the jargon, the almost a deliberate attempt to make people feel like an outsider.
I think so. And what I've realized over time is the people in the financial services industry who are confident and experienced often find ways to make things sound simple. But people who are not confident in their ability, don't understand their subject well, they are the ones that spew the jargon most often. But when you look at in the old days, it would have been brochures, but nowadays, I guess, websites and the like, you'll see an enormous amount of language there that's very difficult for people to understand. And to me, I think, if we make the language complex, and even if you're kind of a English language, major at university, the moment you look at a financial services brochure, the likelihood is by the second or third paragraph, you've found a bunch of words and sentences that you won't understand. And it doesn't need to be like that. I think it's often designed for obfuscation, not really for clarity.
All right. So first, a couple of first points. The first is that this is a long game. You are in it for a long period of time. It's a marathon.
I think it's. I read a saying this week that says, "To have a future, you have to survive the past," and I thought, gee, that's just explains the world of investing and the world of money, in a nutshell. Because a lot of the time when people talk about investing, we'll see all these beautiful graphs about the power of compounding and Warren Buffett's retirement, which we've spoken about. One of the kind of secrets to his success was simply remaining invested for a very long period of time, and that's true, 100% true. And so maybe the very first thing to understand is you cannot be successful in building your own wealth, whatever that might mean for you. You can't do it unless you just get started. And I think very few people just take the leap sometimes. And we can discuss why, but I think that, that intimidation factor is there. So maybe just to say, that number one, just get started. Just start putting a little bit of money away, and try and, if you can, do a debit order or do an amount every 3 months or every 6 months, whatever it is, and then let the money grow. If we think about what's happened in the world in the last couple of weeks and maybe even the last couple of days, you could be forgiven for being really terrified about tariffs going between China and America and all sorts of big potential threats to trade being blocked, or whatever it is, sanctions and the like. All of those are reasons to be fearful. But what's interesting about the world of investing is if you ignore all of that stuff and you put your money into the markets and you let the markets do their thing, they go up and down like crazy. And you and I will do lots of shows about volatility and why things are going crazy now. But the reality is, someone who just puts their money in and let it go and let it grow and grow and grow without pulling it out the whole time, those are the people that are successful. And the reason they are successful and everyone else isn't is because these are the people that just stay invested, they stay calm, they don't get impatient, and they never panic. And that's probably, if we had to talk about the superpower that we have as ordinary individuals over the big institutions, it's that we can take a very long-term view when most institutions, most unit trust fund managers and pension fund managers don't have that luxury, because they're investing on behalf of people who are panicking and who are pulling money out, and we don't need to do that. So if we do realize that it is a long game, and remind yourself the whole time, you can't have a future if you don't survive today, and that means stay invested, then you've got somewhere to go.
I mean, a lot of it is, and I know people pick and choose. I mean, I spend half of my life nowadays talking about this stock or that stock. But so that can be a bit like playing Russian roulette. You've got to avoid that.
So we've got to talk about this. I often say the phrase, and I think maybe I'm giving away my age, but we see this in movies. It's usually the movies about the mob, and someone takes a whole lot of bullets out of a revolver and puts one in the revolver, and usually there are 5 or 6 bullets in a revolver. Then they spin that revolver, and someone puts that revolver to their head and pulls the trigger, hoping that the bullet isn't in the chamber that's just been clicked. And to me, I mean, the reality of investing is you don't want to make decisions like that. And a lot of the time, it will come down to the hype share of the moment. So, be it Nvidia, or it'll be some new hype share of the time where everyone else has made money apparently, and everyone's talking about a share, or it could be a crypto, or it could be whatever the next big thing will be. Now, taking your hard-earned money and putting it all into that, or allocating a large proportion into something that's the current flavor of the month, is very much like playing Russian roulette. You're giving yourself a very small chance of making a lot of money, but what you're also doing is giving yourself a very large chance of losing your money. And I think that's the point people don't understand around playing Russian roulette with your money is you don't want to take those gambles, and that's really what they are, where you're hoping for a very big bet to pay off by taking an extremely risky investment decision. Rather be very consistent and again. play the long game and say, well, gee, I don't understand the new big fangled whatever it is, whether it's a new chip company or a self-driving car. It doesn't matter. If you're reasonably spread and diversified in your investments, doing that and hoping to plod along with your investments will give you a very good chance of making money over a long period of time and avoiding those huge risks, which are most likely going to clean you out. And I can't tell you how many times I meet someone who says, I'm not investing in the stock market. Every time I do it, I lose money. And when you ask them why, it's usually because they've taken a bet on one share, played Russian roulette.
Sure. I mean, I can understand the temptation and people sell it. And there's also, I think part of it is you want to be a part of something. I think that's part of it. There's a lot of emotion there. We need to talk a little bit about debt, Warren. And obviously, through our lives, we are going to have to take on some debt in some ways just to live or to really build a home.
So I'm going to talk about another very kind of movie theme, and that's a Western called The Good, the Bad, and the Ugly, Stephen. And there is a form of good debt, and that's when you buy something with debt that will appreciate in value faster than inflation. In other words, for most of us, it will be the home we're going to live in. And the hope, it's not a guarantee by any means, but the hope is, if you borrow money via a mortgage and you buy a home and you stay in that home for the next 10 or 20 years, there is a fairly good chance that the home will grow in price at a faster rate than the cost of living, faster than inflation. That's good debt. That there is a reason to borrow money. The kind of neutral debt would be when you buy a car because you need to go to work and you need to earn a living, and the only way most of us can do that, especially when we're young and we're starting out, is we have to borrow money to do that. And I understand it. I think that makes sense. So to me, those are the two debts that are reasonable and responsible for us to take. Everything else, when you take on debt to buy something which has no value, which isn't going to grow faster than the inflation rate, is debt that I think should be avoided. Credit cards, personal loans, overdrafts, all of those. And for me, those kinds of debt are a weapon of wealth destruction. We're in a position where we're buying stuff, especially on credit cards, where potentially your interest rate is 20 or 25% a year. And there is no high quality investment that will give you that kind of growth rate with a reasonable probability of delivering over the next 10 or 20 years. You would have to be phenomenally lucky to borrow money at 25%, put it in an investment and get a better return than the interest you're paying. And to me, that's a form of Russian roulette again. So I definitely wouldn't want to borrow money to invest, especially in stuff I don't understand. And I'm happy to put money into a home. And as I say, neutral debt is buying an affordable car. And I think maybe that's the mistake a lot of us make, is we don't buy the affordable car. We buy the car that our salary can sort of justify, and then leave ourselves no money for petrol, for saving, for insurance, medical aid, and all the other things.
Yeah, no, there's so much that happens around cars and debt. 011 883 0702 021 446 0567. How to keep investing simple. Personal finance with Warren Ingram. We've got a question from Chris as well, Warren. He's asking, is it better to pay off my home loan before I start investing? We'll have Warren's answer in a moment.
The Money Show.
Personal finance with Warren Ingram.
And that question from Chris for you, Warren, is it better to pay off my home loan before I start investing? And I imagine this is a very interesting question that a lot of people are going to ask at different phases of their life.
And because your home loan could take somewhere around 10 to 20 years to pay off, it's a question that's going to face you for a reasonably long period of time. And I think it's I think it's very hard to just say yes or no, do one or the other. One of the things about the world of money is there doesn't always have to be, the one choice or the other choice. You could always do both. And I think when you start out and you've got a home loan that you've got 20 years to pay off, and it's a huge amount of money, I'd probably not invest very much money at all, and I would spend the first few months, if not first few years of the home loan period, paying off that home loan, trying to make a big dent in it. So if your home loan repayments are whatever they are, 15,000 a month, try and pay 17,000 a month, because that early repayment of an extra amount into the home loan makes an enormous difference later on in life. You find that you can cut the period of the bond by maybe 3 or 4 years by just paying an extra few thousand into the bond, especially in those early days. So if you can do that for a period of time, and you make a big dent in the bond, and you get ahead of where the bank wants you to be on those home loan repayments, then by all means start investing alongside the home loan repayment. So you might say, well, I'm now doing 19,000 a month into the bond, so I'm going to start doing an extra 2,000 a month, into savings, into investments. And nothing wrong with that. I think doing both makes sense, but you just want to make sure that you've got some breathing room in the bond, and often using your extra paid off money in the bond as an emergency fund makes sense. But I think if you can do that, if you can just get ahead of it, and if something goes wrong, at least you've got a bit of a safety net built in the bond, then go for it and start investing. For some people, I'm one of them. I just don't like to be told what to do at any stage, and owing a bank money feels like being told what to do, and it bothers me. So I'm going to go flat out as fast as I can to pay off my debt, and then I'll start investing again, because I just don't want to owe anybody any money. So preference does matter in this.
I mean, but doesn't that mean that if you were to, if markets move more than inflation, I mean, so should your home. But isn't the trade-off really between what you expect the value of your home to do and what you expect the value of whatever you can invest in markets to do? Isn't that the trade-off?
That's certainly a big factor, Stephen. Also, interest rates. If you're paying. Yeah. There was a time when we as South Africans would have been paying interest at a rate of 13 or 14%. And if the stock market's giving you around 12.5% a year, then it makes no sense to invest. It makes all the sense in the world to try and pay off the home loan as fast as you possibly can. There was a time not that long ago when prime was very low, and you could get an interest rate of 7% or so on a home loan, and if that time comes again, then you might say to yourself, what, I'm going to pay off on a monthly basis the minimum, and maybe invest a bit more, because if I can get a return of 12.5% on stock markets and I'm only paying 7 on my bond, well, I can be a bit slower on the bond. So I think that interest rates versus market growth is an important factor. I think if you're in a property market that's booming, and you're in a sector where prices are going well, it is tempting to pay off a bit more. But if your plan is to live in that house for the next 10 or 20 years, you're probably going to go through 3 or 4 very big cycles in the property market. So I wouldn't focus on that as much as the interest rate cycle.
Somehow ended up in a Cape Town and Joburg conversation in my head there for some reason, as soon as we started talking about property prices. We need to talk about insurance. And obviously, this is a conversation about keeping things simple, but insurance is a must-have.
It is, and especially early in life. So it feels very frustrating when you're trying to build up some savings and you're trying to build up your investments, and then someone's telling you you've got to pay for insurance. And the very simple reason is you can't afford risk when you've got no assets. So if you've just financed your car, and you drive it out the second-hand dealership, let's hope, and you crash that car and you've got no insurance, you've got a real issue now, because you've lost the asset and potentially you financed it. So you've got a real problem, and no other assets to help pay off that problem you've got now. So in that instance, it's the most rational, sensible thing you can do is actually take out insurance on the stuff that you need to generate an income so that you can start saving. And the same will apply to your health and to your ability to earn an income. So, being able to get access to good medical care via some kind of a hospital plan makes sense. And then again, some form of disability or income protection, especially early on in your career, makes a huge amount of sense to me. As you get older and you start building up your assets and and you get more and more capital available, by all means reduce your insurance. You might get to the point later in life when you don't need disability insurance and you don't need life assurance. I think you should always have medical insurance and insurance on your stuff, but maybe you don't need so much. And so you can reduce later when you've got assets, but when you've got no assets and no backup plan, insurance is your backup plan, and it's the thing that might separate you from absolute financial disaster for the rest of your life.
And then, and I think I know what the answer to this is going to be. Is there a particular superpower when it comes to investing over time?
I think knowing that we don't know what's going to happen tomorrow, and I can't tell you, how many times we have this kind of a conversation, around the dinner table, around the braai. When I wake up every morning, one of the very first things I do is I look at my weather app. And I don't know why I do that, because the weather app is probably as reliable as a toss of a coin. But I still do it because I want some form of certainty. I want, even if it's a machine that's not really that reliable, to tell me what the weather's going to do today. What I should do is just look out the window. But it's the same with investments. We want to know what's going to happen tomorrow and in the next few months and years ahead. And the truth is, no one knows. There isn't a single person out there. I mean, if you're an American, I don't think you can predict what Trump's going to do tomorrow, and maybe he can't predict what he's going to do tomorrow. So knowing that, and knowing that the investment markets, the weather, currencies, politics, even sport are unpredictable, is a superpower. Being humble enough to say, I don't know, and no one else knows, gives you a heck of an advantage, because everyone else is looking for certainty. Some people are not humble enough to know that they don't know, and some people, they have a form of arrogance where they think they are cleverer than the markets, and that means they're just waiting for an accident to happen. If you say to yourself, I don't know, the best thing you can do then, spread your investments across a range of different markets and over time, and sit back and watch the story unfold, knowing that you don't know what's going to happen.
Warren Ingram, thanks very much indeed. Do appreciate it. A certified financial planner at Galileo Capital.